Hi, and a very warm welcome to our latest WOA webinar. A very warm welcome to everybody, and I'm delighted to introduce a great team today, a great lineup, to be discussing really what's going on in the alternative finance world. A great title, every cloud has a silver lining, every silver lining has its clouds. You know, what are we doing? Is it half empty or is it half full? Where is the marketplace going? What are we likely to see? So a great discussion to be had here, and I'm really pleased to be joined by some real heavyweights from the industry here, who will be sharing their thoughts and discussions with you. So it's my real pleasure to introduce Steve Box, who's Deputy Chair at Channel Capital Advisors, and Steve is joined by Ian Watson, who's now COO of Channel Capital Advisors. And both these gentlemen, I could spend the next hour talking to you about their experiences in the receivables and open account industry. So I think we better stop there, but just say that you've got some of the most expert people that you can have. And therefore, I'm delighted that they're introduced by another expert, well-known expert in the field of alternative finance, Andre Kasteman. And Andre, welcome to you also. Andre is as well as head of his own consultancy firm. We're delighted that he's the chair of WOA's Alternative Finance Learning Lab. So I'm really pleased that we're here today to be able to have this discussion. We're talking probably around about an hour today. We think we'll probably have maybe 45 minutes or so of discussion here, and then that gives us some time to deal with questions that you, the audience, will have. And of course, you know, if the question arises is topical to the question in debate, we'll answer at that stage. If it's on a different subject, then we'll look to answer your questions towards the end of the webinar. So I think without further ado from me, I'm delighted to hand over the baton to Andre, who's going to basically have a conversation start a conversation here. This isn't about PowerPoint presentations. This is about a discussion. This is about understanding what's going on in the marketplace. So we're very keen on hearing your views out there, and look forward to the debate that's going to happen now. So Andre, my pleasure to pass over to you.
Thank you, John. Great introduction, and delighted to be here again with the WOA team on yet another webinar. Indeed, the last one we organized as part of the Alternative Finance Learning Lab focused on the digitization of negotiable instruments. And it was the first time, indeed, I thought we would not use any slides, although I think I still had a few slides for introduction. But this time, really, we want to focus on our two expert speakers, Steve and Ian. Welcome, gentlemen, indeed, to this special webinar on the alternative finance market situation. I'd like to start with Steve Box and ask Steve, how do you reflect on the current state of the credit markets, taking into account the stormy situations we have witnessed in 2020?
Thanks, Andre, and thank you, John, for having myself and Ian along today as well. I guess before I look forward, I'd like to just take a second to look backwards to maybe 2020. I mean, it's a historical year globally, I think, for the markets and the economy, and you know, be set for a recession now, which we've all faced. Probably a recession that we've not seen anything like this since the Great Depression in 1929. So we were just debating before we came online, trying to reflect on this. It's not something we've seen really before with these types of dynamics at play. But back in March 2020, there was a huge sucking sound of liquidity out of the market. And to give you an example, back in March 2020, 130 European and US corporates withdrew 124 billion from their lenders in just a 3-week period. And that sucking sound was about building a war chest because of the uncertainties moving forward. If we look forward now, banks are still reporting further declines in demand for loans and the drawing of credit lines for the first quarter of 2021. And indeed, that decline in demands will continue. And even for the second quarter, there was an expected rebound to come back, but I'm still seeing that is subdued. I haven't seen that demand return yet. I think a lot of this has come about as a result of the restrictions of corporates and SMEs investing in fixed term assets. And also it's a reflection of the direct government support, especially around the SME, small, medium term enterprises that we're seeing. So I think the demand's going to take a little bit longer to return. What I would also add is that there's loads of liquidity around, in my view, at the moment. And some of that certainly is coming from the alternative finance market. But I am seeing that restriction from the banks at the moment continuing. I'm not so sure whether that's all down to potential bad debts that people are concerned about, or if it's indeed maybe additional concerns that we're not over this pandemic yet, and we don't know what that future is going to look like.
Yes, indeed. And how do you see the liquidity provisions through the open account market developing over the next year or so?
Yeah, it's a great question. As I said before, if I could get every economist and line them up end to end, I'd still not reach a conclusion. I think there's so much uncertainty out there right now. What I would say, though, there is definitely a tightening of credit standards. I do question how banks will deal with the risk-weighted assets on their book, and indeed, how will they evaluate risk going forward when the balance sheets historically will be loaded with maybe relief from government support, relief from business rates, uncertainties because they haven't invested, changing dynamics of their supply chains. So the typical ways that, when I was in banking, I would have been evaluating balance sheets to decide on where to deploy my liquidity. I just wonder how they're going to redress that challenge going forward when the balance sheets won't necessarily reflect a truism of trading over the last year. What I can say is that there are lots of non-bank financial institutions now readily accepted by government who are sitting there with liquidity, including investors wanting to get into short-dated trade instruments, especially into leasing, into inventory. So I do feel that the void that may be created can be filled and will be filled by this demand for short-term dated instruments that is coming from the market. And I'm certainly seeing that from some of the companies I work with. And if I talk about Channel, we've seen Channel Capital, a number of factoring firms trying to talk about structuring long-term solutions now, 3 to 5 years, whilst interest rates are low, but to give them certainty of funding when they emerge from this downturn. So I think there's a mix of tightening, but also while interest rates are low, I think it's a good time to be thinking about your strategy moving forward. And I do feel there's enough liquidity. Sadly, I just don't feel the demand at this stage is where it needs to be, and it will come back. A couple of other things, if I may, just to add, I've been speaking to a number of corporate treasurers recently, and these are A-rated by Moody's, S&P, highly regarded, making billions a year profit, and they have substantial funds from multiple banks. And this is just an example for me, because we talk about low interest rates, but the dynamics that they're facing show you the real cost of money by stretching supply chains. So they're having to hold inventory longer. Their suppliers want paying quicker. Their buyers want to take more time to pay. And they've been back to their banks saying, look, can we have more money, sub 100 basis points? And sadly, the answer at the moment is no. We don't have appetite to expand our liquidity that we provide to you. They've had to raise commercial paper in the market, but not sub 100 basis points, but somewhere between 350 and 450 basis points. So what I'm thinking about here is you have a number of different moving points. You have inflationary pressure coming in, number one, through commodity prices going up. You have the cost of trade for the paperwork, for the vessels. There's a 3-month delay at the moment for vessels to book cargo on a ship going from, let's say, China to Europe, which is causing a problem and driving prices up. You have the cost of money actually going up above the, the base cost, the base rates that we see. And all of this, for me, is leading to inflationary pressure and likely liquidity pressure as companies emerge with more demand coming back to their businesses.
Okay, so it's a kind of an exceptional situation because we have gone through other crises, we know, but this one is very, very different indeed. Ian, do you want
to interrupt for a second before we move on, Andre? Just an observation there, exactly. There does seem to be, I think, considerable uncertainty, doesn't there, in terms of the forecasting of where this is going. A couple of weeks ago, the markets right across Europe took a bit of a dip because there was suddenly fears about inflation and the signs of that beginning to take off, and yet also, on the other hand, there have been, I think, some of the economic forecasting has become a little bit more positive. OECD, for example, if you take just the case of the UK, putting up their forecast from 5 to 7% growth. So there does seem to be a lot of cards being played quite close to chest, if I can put it that way, because this uncertainty about where things will be going, and I think that's another thing which is going to play out over the next few months, isn't it, in terms of where this liquidity is. There's almost a sense that there's people are still looking over their shoulder to see what's going to be happening next, and there's sort of a real feeling of uncertainty as to what the real trends are likely to be.
I think it's a really good point, John. And just to come back before Andre, I guess, passes to Ian, I would add, the question for me is this a short-term blip? Because you've obviously got people that maybe have been waiting to restock for the demand to come back. First of all, is this just something that's a temporary issue because of, let's say, the Evergreen Suez Canal factor, the delay in shipping goods, and therefore this demand that's happening where we've all been at home ordering more, barbecues, ordering more benches, and if you look at lumber at the moment, the costs have gone through the roof. But so is this a short-term issue that's going to smooth, or is this a sustainable issue of inflation, which therefore there'll have to be decisions made upon to reflect those market conditions? And that's the one I'm struggling with at the moment, to see how long this is going to continue for.
I think it's because it's so unprecedented, Steve, really. If you one of the things that we were talking about, trying to relate it back to previous recessions, is that certainly in the last 50, 60, 70 years, any of those recessionary issues were driven by typically economic activities that have triggered it, have created it, whether it be at a macro level, whether it be at a Lehman's and a product level, but something has gone wrong in the system at an economic level, which has had then to a bounce back, and people sort of came back on a uniform sort of way in some respects. Whereas this wasn't caused by an economic issue in itself, it was caused by a pandemic. Now it is a huge economic issue, but what are we trying to, it's not like you're fixing something that had gone wrong. And it sort of feeds into a little bit of what Andre was just saying, with the revisions in GDP growth that people are making about sort of the bounce back. But the bounce back is following a lot of the vaccination progress. So it's not the economic indicators which are driving some of these more positive outcomes or less positive outcomes. It's actually the rollout of vaccinations and the expectations to be able to rebalance economies in that respect. And I think it's just because there isn't that experience. I think everybody's sort of caught in that. Am I positive? Am I not positive about the future? And we had people around for dinner at the weekend, and people around the table had different views about what's going to happen next. And on top of that, you've got huge amounts of liquidity looking for yield, people needing revenue, banks particularly, and other investors. but then you've got this hint of caution about not wanting to expose yourself to too much risk. And it's just a whole sort of, you know, mush of thoughts and ideas at the moment, without a clear path to where the right exit route is in terms of.
I agree, Ian, I agree entirely. And it is that uncertainty of which lever do you pull next?
Yeah.
Do you release more liquidity at a time when maybe insolvencies will, you know, rise? And that may well happen. And that's the forecast of the credit insurers, because naturally there's been these companies surviving on the back of government support. But guess what? You've now got to start paying back for those loans, and you've got to find liquidity. And you know, one thing I'll leave you with, I think from my point of view, there was a PwC survey. If you get a chance to look at it, you know, the audience that's listening in today, they researched 400 odd executives that run, you know, large corporate businesses. More than half of them expect to be saddled with debt on their balance sheets within a year, as the earnings fail to keep pace with spending. They know they have to spend and start to invest. And a similar amount said they're struggling already with debt service repayments. So that's an interesting piece for me. That half of them expect at the moment, plus 61%, haven't even produced a 12-month forecast, because they don't even know what to forecast. And yet a quarter of the workforce or workplaces expect to reduce headcount as well. So you're going to have an unemployment factor, an uncertainty of growth, big spend, and that liquidity has got to come from somewhere. So I do think we're going to see more cash deployed. Already I'm seeing factoring firms I'm associated with seeing a slight demand come back as government support, you know, reduces. But to return, I think, back to, you know, where we were pre the COVID situation, I certainly feel it's going to take a bit of time.
Yeah.
Okay, indeed. Some things will, some market developments will be very positive following this disruption, whereas other business lines or segments or firms will not be able to keep up as the government support comes to an end, and will just go bankrupt. So I think I guess you need to be very selective in those times as a funder or as a credit insurer, because the risk could be going from one extreme to the other, depending on who you're dealing with. But actually, I wouldn't expect a smooth go back to normality. Some businesses will just face bankruptcy as they have to repay those loans, unless there is more government support extending their life cycle. So I guess transparency in their financial situation and business activities will be critical for funders to assess the actual risks of this upturn. So Ian, coming back to you, is it possible, in your view, to predict those risks, and how can we achieve this if it's possible? So the risks associated with what I was just talking about, the economic upturn, as more traditional financing volume increases.
Sure, thanks, Andre. Yeah, I think the risks are probably, you know, there are probably no surprises in terms of where the risks are that we need to consider as financing volumes start to rebound, and let's assume that is going to happen at some point. And as it does, then there are sort of two common risks that we'll always have to be mindful of. Firstly, obviously, credit risk, and the second is probably the risk around fraud, and some of the behaviours that drive fraud. Starting with the credit risk side of things, I think that'll be heavily affected by what the risk appetite is of the credit insurers. And the credit insurers have a huge influence in this space, as we know. There was a survey recently by the International Credit Insurance and Surety Association, where 95% of their members suggested an increase in demand for credit insurance. So the demand is going to go up clearly as volumes recover. But then pretty much all of them are predicting an increase in claims and an increase in credit credit losses for the insurers at the same time, which is going to put that awful pressure in terms of protecting the insurers' balance sheets at the same time as trying to support growth and revenues. Steve's already talked a little bit about sort of like the increased insolvencies that I think everybody's predicting as we do lift out, because of the zombie companies that are out there, the companies that have just hung on through this period because by virtue of the government subsidies and the handouts and the support that's been out there, and also the protectionism that's been offered so that you can't take certain actions against companies. And so many companies facing tax liabilities and the such like are just stacking up a huge debt. So there's no doubt, I think, that's going to come out and will put this pressure back on the insurance companies in terms of credit claims and insolvency losses. But I think if that risk appetite starts to fall for the insurers, then the companies themselves and the clients, our clients, will start to face a dilemma themselves in terms of what level of risk they're prepared to take, because they're going to have to be address, the growth is going to need to be there for them in growth of revenues, because they're the ones whose balance sheets are still saddled with debt. They're the ones facing the increased costs that Steve was just talking about in terms of transportation, the inflationary pressures that are there, and really trying to get their businesses back onto a normal footing means that they need to do business. They need to trade. They need to address and support the increase in demand as and when it's there. So that dilemma will be there, which is, okay, so if the credit insurers aren't there to support me, if that risk appetite isn't strong enough, then who's going to make the decision about where do I trade with or without credit insurance? What level of risk am I going to take? And that's it's easy for us as the financiers to sit back and say, well, that's the poor entrepreneur's judgment call, and he needs to do the best he can, or she needs to do the best they can. But we really know that dilemma is also going to then be passed on to us. It's going to be passed on to us in terms of how much will we support our clients in terms of supporting trade outside of credit insurance. And to some degree, that's going to be a difficult judgment for everybody. Different industries are going to recover quicker than others. Different buyers are going to be more strongly placed than others are. And different markets, as we've already mentioned, are recovering at different rates. COVID is retracting where vaccinations are highest, not retracting where vaccinations are still some way off. And so you've got these different paces of issues which you have to sort of juggle in terms of making risk decisions. And as we were just talking about, balance sheets, 2020 balance sheets aren't necessarily going to be a good basis to make that decision either. In fact, what you could say is that for invoice financiers, that's sort of what they've always sort of harped on about, really, is that we lend to our clients based on their assets, not their previous balance sheet. Well, that's fine, and that's good, and that should play to our strength. But when we come to assessing credit risk for our customer's customer and the debtor risk and where we're going to fund in that places, it's going to put a lot of pressure on us. There's going to be a lot of emotion at times when companies want to support orders. Financiers don't want to support the credit risk that goes with it. And that's going to bring a lot of pressure in terms of relationship management. When you look at some of the considerations, I think, for invoice financiers and working with their clients, some of the things I think you really have to be very careful about. Concentration risk. It's always been a risk for us from a commercial sense, but in terms of credit sense, you could always look to reinsure the concentration risk. But what if you can't reinsure the concentration risk? How far are you prepared to go? Larger value invoices, people trying to ship in larger amounts to make it more cost effective, increases the risk profile. And then new debtors, new customers, new relationships that are formed there. Again, difficult to make good credit judgments in those places. So all in all, the problem starts for the client, because of if the credit appetite isn't there for the insurers to support them, then the problem passes back to the client to say, well, am I still going to do business or not? And entrepreneurs take risks. They like to take risks. They want to do business. They need to do business. But let's not be under any illusion. That risk is then going to pass to us as the financiers of those risks, if we're prepared to take what what level of risk we're prepared to take if the credit insurers aren't there. Anybody can follow credit insurance limits. What do you do when the credit insurance limits aren't there? Because hey, we need the business too. So you know, we're not going to sit totally behind everybody else and go, well, we'll just follow in line, because we all have stakeholders and we all have businesses that we're trying to grow at the same time. So it's going to be a very challenging environment from a credit risk perspective. From the fraud risk, well, fraud risk has always been there. It's been something we live with all the time, as we know. And yes, the professional fraudsters will still be out there. And the only way to avoid a professional fraudster really is to not take him on in the first place. And so, you know, good due diligence up front, good KYC, AML, careful of handovers from one funder to another is often something you have to be very cautious of. But putting professional risk, fraud to one side, I think the risk to survive and the pressure to survive with entrepreneurs is what often leads to bad behavior, should we say, and bad actors, if you like. But it's most often commonly caused by the pressure that entrepreneurs face every day to be able to support their businesses. You know, we have a phrase in our industry that whilst most of our clients are trying to do the right thing, desperate people do desperate things. And with the increasing pressure, and you know, if you've ever worked in a business that's struggling to pay the wages at the end of each month, and you've got your employees looking at you, expecting the money to be there to pay the salaries, that's a huge pressure for the entrepreneur, as we know. And then you put the challenges that the companies and the entrepreneurs are facing in terms of inconsistent supply chains, the reduced credit limits, as we've already talked about, inconsistent demand. You know, you're not getting necessarily, certainly at this stage, a new order every week. You're not getting a new big order every week. Demand's very difficult to predict. The government support being withdrawn, and the protection that it provides, and the different pace of recovery is just adding to that pressure for entrepreneurs. So there is a temptation. I think there'll always be there is a temptation for them. Cut corners on production if they can't quite do the things that they would normally do or like to do. To maybe raise their invoice a little earlier. They are going to fulfill it. It's not that the invoice won't get fulfilled. They're just going to raise it a little earlier. To bank the money happened to arrive into their bank account. Maybe if they just sit on it for a few days, it won't be such a big crime. Or delaying credit notes and just suppressing credit notes because of the impact that can have on their availability. They're all classic things that we've come across before. But as the intensity on entrepreneurs grows, then we have to be more on our guard for them, and we have to be more aware that they're likely to happen. What's the client looking to do? He's trying to maximize his cash advances. He's trying to make sure he's got liquidity to support his businesses. And most clients, most entrepreneurs don't see taking those shortcuts as a long-term thing. It's a short-term issue that they'll fix next week and they'll fix next month. But of course, as we know, it's never that easy, and the hole gets bigger. And the hole gets bigger, and so as such, it makes it too difficult for them to get out of. And we like to think that personal guarantees of the entrepreneur will help us keep them honest, as we say, and make sure everything's above board, because they wouldn't want to be risking their own personal guarantee. I can assure you, having been through multiple recessions, that personal guarantees don't protect you from fraud. They may provide some incentive not to do so, but they don't protect you in the long run, and rarely will they pay you out for the amounts that you lose. So don't be too taken in by the fact that a PG is the ultimate solution. What can you do about it? Well, we've talked about enhancing KYC and AML, and I think operationally we do need to think about enhancing some of our processes as we go with growth. It'll all be about new business. It'll all be about grow, but let's not forget the operational balance that has to go with that to keep us safe. Debt verification, fundamentally important, hugely unpopular. Clients don't like it. Staff don't like doing it quite often. It's a difficult thing to do, but it's essential. Whether you use phone, email, combination of those things, documentation, massively important. Debtor checks, as we know, make sure there's no that the transactions are arm's length. That we're monitoring the transactions, unusual trades, new customers. Some of those things I've already mentioned, and some of those old traditional things that have served us all in good stead over the years around dilution levels, days sales outstanding, and how those profiles are changing to what we would normally expect. And let's remember to watch for those old alligator jaws, you know, increase in sales, but slow down in cash. Increase in sales, slow down in cash. What does that mean? Your lending's going up. And that's fine if you can understand it and you can legitimately explain it, and you know your collateral is good, but it should be asking questions, and so making sure you've got the operational balance that goes with it. Finally, I'd say just using technology, really, making good use of technology to support the things that we do. We can't cover every base. We can't be checking every invoice. We can't check every transaction. So we need technology's help to do that. And there's lots of tools out there. You know, Risk Factor is probably one of the best known in our space, but there's increasing other tools around credit scoring, risk scoring, some of the onboarding, KYC, AML capabilities, AI, and the specialist lending platforms themselves have got so many more features built into them. So there's no single silver bullet to protecting ourselves from risk in this type of environment. But there are some good basic things that we can do that will help us to protect ourselves. But we need to assess for our own organizations what's a best fit, where do we see the need to bolster our operations area or our risk area, where do we need to enhance our operations with systems and additional technology, and what will work best for our organization based on the appetite of our stakeholders to support the growth and to support entrepreneurs who need to grow, want to grow. And let's remember the majority of them are good, honest entrepreneurs trying to do the best they can in what can be difficult circumstances.
Yep.
Can I just add a couple of things, Andre, if I may? Because Ian's made some really good points, but it sort of triggers some thinking, you know, when you hear these things. I mean, history tells us that factoring and receivables works incredibly well, usually during a downturn, a recession, and growth scenarios. But we had 10 years of a benign economy or more. So, you know, we were waiting for something to happen. Sadly, during the recession, but, you know, you've got to call out and give credit to the government and the credit insurers for staying in. But usually in a recession, you know, receivables would be, you know, picking up that opportunity and supporting that liquidity. But the government have done that. So everybody's having to wait a little bit longer to leverage that opportunity and support the SME, the large corporate, the MME. So this is the first time really we need the confidence and the growth. And if you look back on history, you know, factoring receivables will definitely grow. It's going to rebound in a big way, but it's just a case of that patience and confidence returning. The second thing I would say is, you know, we have to give credit to the credit insurers, because I remember a time back in, you know, 2009, I think it was, I had 14,000 limits dropped on me overnight. And that created an absolute nightmare for me. You know, I didn't sleep all night. We had to find alternative insurers to risk share. So I think they've done an amazing job stepping up and staying in during this crisis. So that's important. The other things that Ian raised that really are important, just to add on, it following the cash, and that usually fraud starts small and then they tend to grow when people realize they can maybe get away with it. So having the technology and the humanistic experience to understand when those behaviors are arising, you know, added to that risk factor, different things like Detica TradeNet, Internet of Things, you know, deep dark web analysis like Neotas, whatever you've got, use those, but don't underestimate the experience within the people you have within your teams that carry years of seeing these behaviors over time. And they've either got to be embedded into the formulas driving the AI, or they've certainly got to be something that overlays the AI or formula driven analytics, because you can't get away from that sniff test or kicking the tires, the gut feel. And it's really important that people looking towards a, you know, a fully fledged platform scenario don't forget that experience sitting around it, for me, is incredibly important.
I think also, if I might add, because I think it fits with the question that's been put up regarding the fact that factoring has fallen faster in the UK than the GDP, and that's happened in other countries. And this relationship between the volume and growth of receivables finance and what's going on in the wider economy. This is something I've been following for the last 16 years right across Europe, and there is a very strong positive correlation between the rate of growth of receivables finance and the rate of growth of GDP, and vice versa. So the ratio is about 1.8. So for every 1% growth in GDP, we can expect on average around 1.8 growth in receivables finance, and vice versa. We're saying it's quite uncanny, the level of correlation that that this is followed through the 2008 recession. It followed in the minor 2012-2013 recession. It's happened now again in a completely separate environment. So the fact is that, you know, as we see GDP start to grow again, we can be very confident that the rate of growth of receivables finance will also take off. Now, of course, it will vary from one country to another. It will vary from circumstance to circumstance, but there is a very clear relationship between the two.
I think that's heavily dependent, John, again, I think, on the credit insurers playing their part in partnership. Otherwise, you may see this natural hedge back to trade documentation instruments, paper-driven solutions. And we want to avoid that, because you know, if people can work on an open account, trust, and even buyer-centric models that shift the risk to the larger entity, then, you know, it keeps that receivables infrastructure robust, and it's very agile. My worry is that if the credit insurers do retrench, then you get that natural drag back when you want to be supporting that growth, as you say, 1.8% against 1% GDP.
Exactly, and of course there are lots of different factors which will all operate simultaneously. What I'm talking about is a correlation, not a cause and effect. So, you know, there will be.
Interesting.
But I also must say I'm delighted that Ian's talking about the alligators, because it's about 15 years ago since I first started teaching that in various factoring lectures. So it's got through somewhere.
Still holds good, John.
Okay.
Yeah,
thanks, Andre.
And indeed, thank you, John, for raising that question we see in the chat, and I invite the other participants indeed to do the same, to submit their questions. The second part of John's question is he'd like to understand why off-balance sheet treatment is so prominent. Is that for you, Steve? Or...
Well, do you want me to lead with
yes?
that? Well, I think there's a number of things at play here. You know, I was fortunate enough in a previous role to talk to probably 100 of the top 350 FTSE treasurers and CFOs, whether that's a corporate treasurer event or seeing them one-to-one, talking about inventory solutions with a prior company I worked with. And it's really funny, a lot of them at the time were saying, actually, it's not so much off balance sheet that's the priority. It's more about, we want non-debt. So we want extended payables, or we want off balance sheet, but we want to drive our debt down as a key performance indicator of their metrics of measure. So I think off balance sheet forms part of that solution. Now, why I think it may be becoming even more important. One, it can drive efficiency of cost of your money. It can drive the ability to get a rating on your assets, which I think is incredibly important going forward, because again, that presents a strong value given and an opinion given to your business model. I also feel that some of the off-balance sheet structures that treasurers could use in the past have now been eroded by IFRS, GAAP. And what I'm talking about here, you used to be able to do a purchase and resale of inventory. So you could sell and buy back and create, you know, an extended payable or an off-balance sheet treatment. That went a few years ago. You cannot use that mechanism anymore. there's been a change to the treatment of leases. So you've got IFRS changes of accounting, which say you can no longer treat certain leases in certain situations as off balance sheet. So all of these things are starting to come back on balance sheet. That's going to be changing, rating, gearing, leverage, and therefore receivables as a short-term derecognized instrument is likely to become even more relevant as we move forward, because certain mechanisms and assets can no longer be treated in certain ways as they used to be 3 or 4 years ago.
Yeah, indeed. Hopefully it will stay like that so that receivables continue.
I think it will. I mean, certainly speaking to some of the lawyers and the legal opinion out there is it, if you have a receivable and you sell it fully derecognized with no comeback, and it's been given the right treatment and opinion by the corporate lawyer or auditors, and indeed the liquidity providers auditors, there doesn't appear to be any pressure in that scenario. What I do think will change is the need for you to be more clear and transparent within your reporting on your accounts around the type of structures that you're putting in play for your corporate business.
Yeah, I think that's particularly true about reverse factoring and supply chain. Some of those supply chain structures.
Correct. Yeah.
Okay,
Hopefully
very
good.
Yes, I hope so. Definitely to me, John, do not hesitate in the chat to raise more questions if you wish, or I invite also the others to do the same. You don't get a chance to talk to Ian and Steve every day on those very interesting topics. So here is your chance. Of course, you can always contact Steve and Ian separately. We have a bit of time still, so I'd like to ask both of you, Ian and Steve, what's your forecast for funders? How does it look like, the forecast?
What do you mean, Andre? Could you explain that a little bit more?
Your forecast in terms of how your activities will expand, will continue to. You touched on some of it already, indeed. But really for you as a funder.
I'll let, as I did the off-balance sheet question, I think I'll pass this over to Ian to start, if you wouldn't mind.
Thanks, Steve. That's very kind. In terms of a forecast, I think I'll be like every other chief executive that Steve mentioned he'd spoken to, who said he didn't write a forecast because it's so difficult to know where to start. I think the forecast is one of, we expect growth. I mean, if we look at channel, we're expecting growth. We're expecting strong growth in the second half of this year. But I think it's a question of when the flag's going to get dropped, really. And it's about having that confidence in the market and the confidence in the clients to want to take on additional debt and to take on additional financing. And they're confident that demand is there and consistently there for them to be prepared to do it. But I think our forecast is one of confidence, of growth, of expectation. I think the couple of things that I think support that. One is going back to that comment we made earlier about we finance assets. We don't finance balance sheets in quite the same way as perhaps some of the other financial institutions look at them. And therefore, we're interested more in the today and the tomorrow than we are in the yesterday when it comes to putting funding facilities in place. Secondly, I think that there is a move towards potentially more creative financing solutions, not just your typical, whether you're a factor looking for a typical back-to-back type facility, or if you're a large corporate looking for some sort of receivable-based facility. I think there is increasing distribution of tools and structures that can work for you. And I think that actually makes the market quite exciting and quite dynamic. And that's before you bring into play the whole range of fintechs that are out there right now. So my forecast is actually one of positiveness. I'm looking very positively towards the future. I think we're in for an exciting time. think there will be challenges that we've already talked about, but I think it will be exciting, and I think it'll be exciting because of the range of options that'll be out there. And it isn't going to be a single trick job. This is going to be a multiple faceted process going forwards in terms of how any of us go about growing our business. So Channel is looking at, we're looking at sort of 3-4 different ways of growing our cash employed, if you like, and the funds we put out to entrepreneurs. And we know we can't just rely on one of those. We have to look at supporting different types of businesses at different stages in their development, using different tools and models. And that's what we think at Channel we gives us the best bite at the cherry, if you like.
Okay,
Steve?
thank you.
Sure. Thanks, Ian. I would agree entirely. I think it's exciting times to get yourselves ready for growth, because it's going to come, without a doubt. And, I can say this having had 30-40 years in corporate finance, in receivables, in trade, a number of different products, but it's going to come. The worry is that how do you breed confidence into businesses when you don't know when the next pandemic may arise, or the shift in trading supply chains? But the things that I'm really positive about is that years ago, I'm not so sure corporates would have been turning their head to alternative finance. They would have always relied on their banks and given share of wallet. Now I think there's cometh the hour where alternative finance is being seen as one of the diversifications of a funding pool that can support the long-term strategic ambitions of a corporate, to have a pool of funding options where some may draw back when others have got more appetite. And so I certainly advise the companies that I work with is to have diversification is very valuable. The second one is to have committed lines, have lines that aren't going to be drawn. And I've sadly seen that by some alternative players. They pull away as soon as there's an issue. And as a result, it leaves this void of liquidity. And that's a real issue. The same when credit insurers did it. So one thing, I'm pleased, and why I've decided to work with Channel is that we can do 3 to 5 year committed lines. We can do off balance sheet. We can give certainty of funding at a time when others pull back. So if these treasurers, CFOs are looking to plan, what we want to be able to do is plan and give some certainty. And I believe more and more people need to be considering how you stay during tough times with your clients, not just in the good times. And those knee-jerk reactions leave a poor brand value, and that isn't sustainable. I think you've got to see a client through and navigate through with a client the tough times and come out the other side. The other things for me, I'm seeing a shift in the days sales outstanding. So people are having to wait longer to get paid. I said that, I think, at the beginning. People are wanting to get paid earlier as a supplier. So being a good corporate citizen, I'm having to pay my suppliers early to keep my supply chain well oiled. And the inventory is going out. I'm having to hold inventory, even at the moment, 7 days longer than normal. And that's built on the fact I want inventory ready to deploy for demand. And I'm also having to think about how long it will take me to get my inventory in with all these delays of vessels and all these delays on manufacturing capability. So all of these factors are leading to liquidity demand and growth. Imagine multiplying that with confidence and, back to John's point, GDP growth. You put all of those into a bottle, you can't not expect huge demand for funding. And I just feel we're well positioned, very well positioned for that, both for funding receivables and for funding inventory, which we very much want to help companies with moving forward.
Very good, thank you, Steve. In the interest of time, I will focus on the questions because we had 2 more questions here in the chat. How will the new regulatory definition of default affect the European market?
Steve, over to you, mate.
Well, no, that's one I would have to be honest and have a look at in terms of.
Okay.
I know the insolvency. They're trying to bring a continuity and consistency to the insolvency regime. because there's too many variables that are sitting within that EU economic environment. And I think part of that is to make sure that there are triggers, early triggers, to slow down an insolvency, to allow corporates or businesses to survive. But if you're able to enlighten me on the new directives, whether that's John or Andre, then I may be able to give an opinion, something I need to go and read up on.
Yeah, okay, we'll all have to do, because I can't help you here.
Well, I think I
sure,
can give a quick answer, and that is that the definition of default is having a quite dramatic effect on the European industry, receivables finance industry. The difficulty that it is that the default is being applied to individual invoices, which then apply to the account. So in receivables finance, you can often have a situation where you've got 20 perfectly good invoices, but one invoice which is held back for non-payment because of dispute or disagreement. If that's not paid, then the whole account is considered as going into default. Now, in the Northern European countries, where days outstanding are generally quite short, the impact is relatively minor. But in the southern countries, particularly Italy, where there's a lot of public sector debt involved in receivables finance, over half of the outstanding debt is potentially going into default, according to this definition. So it's having a dramatic effect on the potential liquidity. And there are quite urgent discussions going on in Europe to actually try and get a recognition of the fact that simply because one invoice has not been paid in 100 does not mean the account should be discovered as being in default.
Is that one invoice, John, relating to the same buyer?
Yes, yes, that's right. That's right. So one invoice within an account. So, for example, yeah, I buy a dozen boxes of glasses from you, and one box is smashed. It doesn't mean to say that I'm not going to pay for the other 11. It doesn't mean to say there's anything wrong with that account. It means there's something wrong with that invoice. But the definition of default says, no, the account is overdue, therefore it's in default, therefore you have an issue.
Yeah, I think a blanket approach to that, I mean, thank you for sharing that, by the way, but my view would be a blanket approach to that is very dangerous. But I do think what it drives is to be very clear with your data and your information captured of why that invoice is being questioned. And it is certainly a red flag. You know, if I have a delay on a particular invoice, that could lead to potential breach, or somebody claiming under a contract that as a consequence, I'm not paying anything else because it's a material breach of a contract of supply. But then again, I think to call all 200 invoices, for example, as in breach or in default, I think that's a little bit extreme.
It's a bit extreme, and it also, unfortunately, also applies if the debt is simply slow paid. And again, if that's culturally the case, where days outstanding can often be 180, then again, suddenly we're in default simply because of business practice, and not because of any inherent problem or failure within the debt itself.
I think the other danger, John, sorry to interrupt. I think the other danger, I'm just thinking this, I want to take a bit of time to take that away and think, but what I would say is there's a danger in bringing that in as a very hard decision, that you would get behavioralization changes between buyer and seller. So I would say, instead of me having a 30 days date of invoice or end of month following on my invoice, why don't I, if I know what you're important to me and I need the treatment of my receivables funded, why don't we agree that it's a 90-day term on the invoice, but you pay me 30, 60?
Yes.
So I think you've got to be very careful that we don't change the dynamics of behavior in the context of trying to meet that requirement.
Yeah. Yep. Yeah, and of course there is ongoing discussion in the various sort of particularly affected countries to try and find a way locally to deal with that with their reporting authorities. But as you can imagine, it's quite a debate.
I think it also happens in some of the Northern Hemisphere countries, where some of the payment terms are defined a little bit more about what you can and can't do, and the buyer and the supplier want to navigate their way outside of those government stated structures. And I think it's a little bit about what Steve was referring to, and that isn't proving very helpful either for encouraging trade, and is encouraging a little bit of not bad behavior, but encouraging people to do creative things which the rules weren't made
Absolutely.
to allow. So I can see why there is a bit of an issue to try and resolve some of these things.
Interesting.
Very good. Maybe that's also an area where some banking associations or trade associations like ITFA or ICC could work to lobby or influence the regulators. So a final question, because we have 5 minutes to go, although we don't have necessarily a hard stop, but I'd like to try to possibly keep it short. If receivables are an asset class, and one where investor interest is growing, can you please share views on our responsibility to investors? I guess John here mentions the responsibility of fund managers like Channel towards the liquidity investors.
Yeah, so that's interesting. I mean, do you want to go in, or shall I?
I'll give it a go if you like, Steve.
Yeah, and I'll pick up at the end if you want me to.
Yeah. It's as a program manager, you have a bit of a split personality. You have to protect the interests of the investor, but you're also working with the interests of the client. And our path in there is to make sure that the integrity of the facility, the way it was set up and the way it was structured, is maintained at all times. And if it isn't maintained, then we either are working with the client to help them to address the issues, but at the same time, we're bringing those issues to the attention of the investor and to some degree helping them understand the severity or the magnitude that the investor needs to take notice of. So I see our role as being sort of a little bit, I don't see us necessarily as totally the policeman, but we're certainly the guardian a little of the facility in such a way that enables the investor to feel confident that they're getting good information, that the information they get is accurate, and that the structure of the facility has been established is being maintained and is being performed in the spirit in which it was put together. And then for the client, that the client is therefore also from our perspective, getting the benefit of the facility that they signed up for in the first place. So it's how we balance those two dynamics to ensure that we remain good guardians overall, that we ensure there's integrity in the structure and in the way the facility operates, but that we're looking out for both parties, and we're looking out for both parties to build good relationships, because despite everything and all the stuff that we go on about, systems, technology, asset classes, third-party stakeholders, blah, 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 relationships and people and trust is really still the fundamental piece of it. And a big part of our role is maintaining trust with the investor and trust for the corporate borrower. I think that's how I'd summarize.
Yeah, just a good summary. I haven't got much to add. I think for me, brand is key, and trust. You don't trade like a company like Channel for many years and still get cheap funding from institutional investors unless you're protecting their funding. And that means something that I'm pleased about as well is that we do the cash program management. So we control the cash, we can see it. We have daily monitoring and extraction methodology from our clients. We have backup services that help us. So we have an infrastructure that operates to preserve the funds. We treat the funds from investors as though it's our own, Andre, to be honest. But at the same time, that fund has to be put to work. So we also have to make sure that we can be as slick as possible and we can be as time sensitive as possible to attract clients to us. So that means putting an infrastructure of a brilliant service experience to the client, but not doing that and rushing without us understanding the business to the point that we know we're protecting the interests of our investor. Because it's a bit like equity to a degree, we're having someone's cash invested into Channel for us to program and control to lend out at very fine rates long term. So, people aren't coming out of this as an investor in 6 months or 3 months. These are 3 to 5 year terms. So I think if you that question may have been raised quite rightly because of certain situations that may have arisen over the last 6 months in the market of investor funds being deployed and certain issues arising. But there is massive differentiation, in my view, on the way we control and monitor and protect the interest of the investor at the same time as driving client experience, which is fundamentally important to us.
Thank you. Thank you, Steve and Ian. That was a pure delight for me also to benefit from your insights and also get questions from our participants. Delighted to have been through this hour with you, and surely we'll be back in another World of Open Account session in the future. I have a few ideas for the upcoming sessions, which I will discuss with John and Eric. But in the meantime, thank you very much, Ian and Steve, for your insights. I hope the audience enjoyed it as much as I did. And with this, I'd like to turn over to John for the final words. Thank you.
Well, thank you, Andre, and again, indeed, Stephen, and thank you very much indeed for your insights. And as ever, when we have these conversations, an hour goes by just like that, and we could carry on for quite some time yet, I'm sure. So thank you to you, and thank you to our audience. And I'd simply say, yes, we look to have a continuing program of webinars on topics and subjects that are important and merit some open discussion and debate. And obviously we'd be delighted if anybody in the audience would like to think about becoming a WOA member and becoming part of our worldwide community. But thank you very much indeed for joining us, and with that I will take my leave. Thank you, gentlemen, very much for joining us.
Thank you very
Goodbye.
much.
Thank you. Bye.